Welcome back to Let's Invest with the Australian Securities Exchange. This video will give an overview of the four main asset classes and some important things to consider when investing. It is important to note that no investment is without risk, and this video does not constitute financial advice. The four main asset classes are cash, fixed interest, property, and shares. Cash is money invested in a building society or bank, and its main benefit is liquidity. Liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. The more liquid an asset is, the easier and more efficient it is to turn it back into cash. Fixed interest includes short or long-term interest rate products such as bonds, deposits, bank bills, and various other securities. Property can refer to residential, rural, industrial, or commercial property. Shares represent ownership in a company, entitling the shareholder to a portion of its profits and a say in its decision-making. When considering investments, some important factors to consider include return on investment, capital and income security, liquidity, minimum investment, costs, time frame for performance, choice and ability to diversify, and taxation. Return on investment can include income, such as interest from bank accounts, dividends from shares, rent from property, and distributions from trusts. Capital growth, which is the value increase over time, is another factor to consider. Capital and income security refers to the risk of capital loss and whether you will be able to sell your investment and whether it will decrease in value. Volatility is the tendency of the value of an investment to fluctuate as buyers and sellers leave the market. Ease of investment can vary depending on the type of asset class. Finding a suitable investment property and negotiating the price can be complicated, while establishing an account with a stockbroker is relatively easy. Liquidity is the ease with which an asset can be bought or sold in the market. The Australian market is noted for having poor liquidity outside of the top 200 companies. Spread refers to the difference between the highest price a buyer is willing to pay for an asset and the lowest price a seller is willing to accept for the same asset. It is a measure of liquidity and market efficiency. Minimum investments vary based on the stockbroker and asset class. Cash investments and managed funds usually have lower entry levels. Property investments generally require high minimum investments, but investing in property trusts allows entry with less money. Costs associated with investments include transaction costs and ongoing ownership costs. Transaction costs for direct share market investments include brokerage and GST, while there are no stamp duty or ongoing fees. Time frame performance refers to how well an investment performs over a specific period. Some investments may be better suited for short-term gains, while others may require a longer time horizon. Maturity refers to the point at which you can sell an investment. Shares do not have a specific maturity date. Timing is crucial when buying and selling investments. Low liquidity can lead to significant price swings, affecting short-term investors more than others. For medium to long-term investors, the challenge is to be patient and let time pass. Choice and diversifying. The ASX has many foreign companies listed, with more than two-thirds of the listed companies in the industrial sector, including banking and retail, while the rest are in the mining and exploration resource sectors. Diversifying involves investing your money in different assets, such as stocks, bonds, real estate, and commodities, to reduce the risk of losing all your investment in one asset and to maximize potential returns. Managed funds are collective investment schemes where a fund manager invests money from multiple investors in a diversified portfolio of assets. They offer a cost-effective way to diversify investments across local and overseas share markets, property, and cash. Exchange-traded funds, ETFs, are investment funds that are traded on stock exchanges like shares. They typically track a particular market index or sector and provide quick exposure to a diverse range of assets with relatively low management fees. Tax implications should also be considered when investing, including the tax treatment of different investment types, potential capital gains tax liabilities when selling investments, and the impact of dividends on taxable income. Thank you for watching this video about the 4 main asset classes and considerations for investors. Click on the link for flashcards to test your learning. Don't forget to like and subscribe for more valuable content.